Good afternoon, everyone. My name is Raghu Rajan. I'm the chair of the Group of 30. Welcome to this panel in the spring meetings. Just a note on the Group of 30, we're a public body comprised, well, I should say we're a global body comprised of members from the private sector, the public sector, academia, and we organize events like this. We meet on global issues, and we also produce papers on pressing global challenges, some of which are outside. Now, at a time of really rapidly changing global dynamics, including, of course, the geopolitical landscape, rising debt challenges in a number of countries, concerns about financial vulnerability, about the independence of central banks, about new technologies which have the potential to perhaps even erase our world, the group's role in fostering debate, understanding, and reflection has become really very, very important. In this light, today's seminar on digital finance is a continuation of our work. Thank you all for joining us today. I see many friends, both from the private sector, the public sector, but also from the press here. Thank you for being here and for your continued engagement. I should note for members of the panel that the press are in the audience, the remarks are on the record, and it is also being live streamed. Finally, let me thank Managing Director Kristalina Georgieva and the International Monetary Fund, who, as always, have welcomed us here, and we thank them for their hospitality for this event. The partnership is a long one, and I look forward to the Managing Director's opening remarks. Kristalina, please.
Thank you very much, Raghu. It is my great pleasure and honor to be here for a G30 seminar. I need to remind the audience that when you gather, it is on the most important topics on the minds of policy makers, and it is for this reason we at the IMF are delighted to offer to host you. And as a gesture of how much we value the G30, we have dispatched one of the brightest IMFers, Jayla Pazarbashioglu, to work with you. Last time when I was introducing a topic, the speaker was Kevin Walsh, and the topic was central banking. Now I'm introducing digital money, and after me there would be a panel, and there would be distinguished panelists. Who knows what their role in the future might be. So listen attentively. We meet at the time when the resilience of the global economy is tested yet again. The fallout from the war in the Middle East had reminded us that we live in a shock-prone world. The world economy is being reshaped by shocks, but also by tremendously powerful forces of transformation, from geopolitics and trade to demographics and, yes, technology. While these transformations are adding to the uncertainty faced by countries, they also create tremendous opportunities. Digital finance touches on both sides of the coin, the opportunities and the risks. The G30's research has shown this very well. Ken Rogoff and his co-authors laid this out in a practical and solutions-oriented manner in their G30 Future of Money report. It is a very useful analysis of how cryptocurrencies, stablecoins, and central bank digital currencies are reshaping the international monetary system and how policymakers should proceed. Very useful also for us at the fund. It is front and center in the role we play as the guardian of the international monetary system. And just in time for the meetings, the G30, sorry, there are far too many Gs these days. And I go and speak to all of them, so please bear with me. The G30 launched a new report from Klaus Knott, who will be a panelist after the opening, and Augustine Carsten on the tremendous growth of non-banks, many of which are involved in digital finance. It has a clear and urgent call for coordinated policy action, including stronger regulation, enhanced central bank tools, expanded safety nets, and improved global cooperation where the fund definitely plays an important role. Both reports show how the work of the G30 complements what we do at the IMF. I want to stress over this week, one of the very clear demands for fund analysis, capacity development, and engagement is on policy analysis and advice on the many aspects of digital finance. In fact, stable coins are top of mind for many of our members. The CBDCs are of interest, how CBDCs and stable coins may coexist. And of course, a lot of interest in tokenized assets. We published a note on tokenized finance, which we see as a structural evolution in the financial architecture. Given how broad the potential impact may be, clear policy frameworks are especially important, as is legal certainty and international cooperation. Our membership has been calling for this kind of analysis. They clearly have concerns about certain aspects of the rapid development of digital finance. Stable coins, for example, can become unstable if their underlying assets lose value, or if users lose confidence in them. Stealth dollarization and loss of monetary sovereignty are possible, making it harder for countries to manage their economies, including in crisis, and crises are now coming more often. Financial integrity issues such as money laundering and terrorism financing are also risks. But the advantages are very clear. Digital finance has improved access to finance for unbanked people in many emerging market and developing economies. Stable coins can make cross-border transactions, including remittances, less expensive, faster, more efficient. By reducing transaction costs, tokenization can make more assets available to more people. All of this innovation can help countries promote financial inclusion, and it could make domestic payment system more efficient and actually more resilient. And as this new world of digital finance takes shape, it will be important to develop a comprehensive, globally consistent, and coordinated regulatory framework for crypto assets. And I cannot stress that enough. It is hard to do, but that doesn't make it avoidable as a task in front of us. We have to support this with reliable and adequate data monitoring, supervision, and enforcement. And this gets into the heart of our work at the fund, safeguarding the stability of the international monetary system. We know that international payment systems are the essential infrastructure that enables households and businesses to transact with confidence. And in that sense, it wouldn't surprise you that safe and inclusive digital finance will be a key theme at the annual meetings in Thailand. So today's discussion is a stepping stone towards the next big gathering of our membership. We will present new work on digital fraud with a focus on ensuring that payment systems remain safe, resilient, and fit for the future. So we live in a more uncertain world, and that means that we have to think about how we enlarge the tools at our disposal to build resilience, and how can we still keep our eyes on the big prize, which is strengthen growth, because when countries grow, all other things equal, they have more resources and capabilities to face the shocks to come. We need to pay very close attention to something that is still not quite there when we talk about digital finance, guardrails. So we do what we do, but we also protect businesses and households. William Gibson, to paraphrase what he says, if we take his words, if digital finance is the future has arrived. It is right here. And the question is how best to harness it for the benefits of our members, and most importantly, for the benefits of people. And I'm so glad that the G30 is adding your incredible intellectual power to answer some of these questions, help us grab the opportunities and manage the risks. So welcome on stage of those who would lead us through the, Raghu, you're going to lead this panel. And from me, I wish the G30, you are so smart, you're so capable, keep doing what you're doing. And Jayla, thank you for serving this community as well as you have served us. Thank you.
Thank you. That was a very kind advertisement from the managing director for the Group of 30. And I think following her instructions, I think it's time we start talking about digital finance. So maybe we start, first, the panel of experts needs no introduction, and I'm not going to proceed to give it. It's there in your brochures. But we have a fantastic panel today. Let's start with Heath Tarbert, who is going to tell us why we should have stablecoins. What's good about them? Why do we need them?
Yeah, well, thank you so much for having me. And I guess I would boil it down. If I was talking to my mother or my grandmother, I would say, for the first time ever, it is now possible to effectively send money as instantaneously, safely, securely, and with near zero cost as you send an email. And it's the advent of blockchain technology and stable coins, at least at this point in time. There are other kinds of digital fiat currencies that we're going to talk about on this panel, but right now, the ones that are actually in effect, where anyone around the world that has a phone can have a wallet and can literally send value. And in many ways, this is the revolution. You've often heard of Web 3, and I was always like, what is Web 3? It's the third generation of the internet, which through blockchain technology allows you to send value. So what are we actually seeing in the real world? Well, a few years ago, if you were to ask me, who's using stablecoins and why, the primary use case would just simply be in digital asset markets. You're buying Bitcoin, you're buying ETH, you're buying other kinds of digital assets. You want a digitally native token over those blockchains to be able to exchange it. And that's the case, and that's still ongoing. As we're seeing more and more of the traditional financial system tokenize, as Kristalina mentioned, we're seeing large traditional companies building money market funds and they're being tokenized. You're also seeing stablecoins as the cash leg of those. But that's the crypto stuff, I would say. Over the last couple of years, we've seen a divergence where stablecoin volume continues to grow, both volume as well as circulation, even if the digital asset markets are sort of up and down. So what are those other use cases? Well, one of them is store of value. There are people all over the world who would love to get their hands on a euro, a dollar, sort of a major currency, but don't have access to those denominated bank accounts in their home country. But if they've got a phone, they can get access to it through stable coins. Cross-border remittances, something, again, that was mentioned earlier. Right now, some of the most vulnerable workers that are away from their family are paying something like 600 basis points to be able to send money back and forth. Again, this virtually brings it down to little cost. So there's amazing savings there. We're also seeing major players, not just simply individuals, starting to use stablecoins. There's a large international financial institution that uses stablecoins to move money inside of its network because it has places all around the world. We're also seeing folks move money across borders. What would normally take 72 hours, for example, to move money from Singapore to Brazil in that currency, using stable coins as the rail in between, we can reduce it to 72 seconds. And then finally, there is also humanitarian, because again, anybody with a phone, you can get money to. So Circle, for example, has partnered with the United Nations to be able to send money in USDC, our digital dollar, to Ukrainian refugees who were literally leaving the battlefield, right? They could not get access to their banks. So these are revolutionary use cases. And if I were to just end this by saying, well, what about the next few years? Think about AI. Think about AI agents and micropayments. Well, again, it's unclear how that's going to interface with the traditional system, but you could see the smart contract technology, the programmability that comes with every stablecoin being used to interact in new ways that, quite frankly, we haven't even thought of. So that's why I think it's very important for us to consider these issues.
It's wonderful, Heath. We'll come back to AI. I'm sure no panel in this meeting can get away from AI. But Venkat, as CEO of Barclays, you're the guys, these guys want, whose lunch these guys want to eat.
And dinner.
At least some of it. Not all of it, but some of it. How do you respond to the promise and challenges of digital finance more broadly? I don't want to restrict it to stable coins, but digital finance more broadly.
Well, thank you, Raghu. Thank you to the G30 for having us. And thanks for putting a 330-year-old bank juxtaposed to the future. But, you know, Paul Volcker famously said that the only useful innovation in modern banking was the automated teller machine, the ATM. Now, this holds special meaning for me because the ATM was actually first deployed in 1967 in a Barclays branch in London. And the story goes, by the way, that the CEO, the then CEO, was convinced of its value over a couple of martinis. So what I have to say is the current CEO is not quite so quick on the uptake. So I've spent a number of years trying to study and understand digital finance. But I do now believe, as the managing director said, we are not just at an inflection point, but the future is here. So I want to talk about it in three parts. First is, what are the customer needs that we think digital assets can solve? Second, how do we go about solving those needs? And third, what do we think as a bank the safeguards need to be in the system? You know, look, in a most basic sense, and I'm embarrassed to sort of say this in front of this group, but I think of banking relatively simply. We do four things. We store people's money, we move their money, we lend them money, and we invest their money. That's it. And by money, we can mean cash, we can mean securities, we can mean, you know, physical assets. And for this purpose, I want to talk about digital assets more broadly as digital versions, not representations, but digital versions of these traditional securities. So it can mean stablecoin, it can mean tokenized deposits, but it does not mean for this purpose crypto or memes or meme coins, which are inherently digital but more speculative in nature. And these things can, of course, be centralized as a central bank or bank deposits, or it can be decentralized. So the basic question is, why do we need these? Right? I mean, after all, at Barclays and all modern banks, 95, 99% of all interaction is on an app. The app shows you what you have. But, and you know, securities have been, quote unquote, dematerialized for decades. And institutions and individuals transact using the app. But what it is that the current system is a digital representation or a banking system for traditional assets. It gives you a snapshot of what's in your account and what may be there in a day or three, depending on when things settle. And what usually happens is that holding, payment, and contractual information about these assets are kept separately, right? And they're often reconciled with difficulty and usually confirmed with a delay. And everything happens in units of business days and only on business days, which is a point I think Heath was getting to. So obviously then transactions can still be cumbersome. If you want to do a mortgage, there's a buyer, a seller, contracts, lawyers in the room, and often some simultaneous exchange of documents. So what digital assets offer for a customer, in our view, is shared systems of records, flexible custodial arrangements, 24/7 settlement and movement, near instant transfer of payments, particularly across borders, and maybe even intraday interest, right? All sounds very good. And stable coins and tokenized deposits are at the forefront of this. So the most fundamental challenge for a bank is not just to develop these capabilities, but to do it consistently and in an interoperable way so that the banks are not fragmented. And it's that connective tissue that when we try to develop, that we're all trying to develop, that is the most important thing for us to do. And in the UK, for instance, there are two large initiatives. I see the governor here. One of them is very beautifully named the Great British Digital Banking Initiative, GBTD, Great British Tokenized Deposits. So there's a beautiful field where we sit in a beautiful tent, and it's always England, and then where we are designing tokenized deposits. The second thing is a Retail Payments Infrastructure Board, which is very important, which is modernizing the payment system, not just faster payments, as they call them in the UK, but also to have smart information associated with the payments. And then, of course, we are part of initiatives with the London Stock Exchange Group on digital representation of securities and so on. In this future, the digital assets are not a parallel system. They're a replication or a replacement of a traditional system. But before we go there, before even we talk about the technology and the interoperability, which are very difficult, we have to think about the role of policy and regulation, because after all, we face off millions and millions of customers. And the issue is that digital payments and digital technology is not without risk. So in the US, of course, the Genius Act has created a framework for stable coins that's helpful. In the UK, the regulators are working with the banks to employ safeguards. But the most important thing is, if, like in anything else, if you have fragmented rules, fragmented systems increase cost and increase complexity. So there's a level playing field argument there. Importantly, there's a customer protection argument, which is what I feel particularly strongly about. We need to explain to customers not just the nature of these assets, and many struggle to understand traditional assets, but also what protections they may have or not have. Are stable coins subject to deposit insurance, or are they not? Should they be? Should they not? How does it affect monetary policy if they're outside of the deposit system? Equally, as part of customer protection, and we're going to talk about AI and maybe mythos, but we have to worry about the extra scope for fraud. Because today you have fraud which goes to misrepresenting holdings. How many dollars do I have in my bank account? And it can forge payments, right? But if you then have a system where not only that information, but the nature of the security, its interest rate, its maturity, everything is digitally held and held in a decentralized way, what protection do you have and should you create from criminals who can distort all the information? And I think that's the last part. So in closing, I think there's no turning back. The future is here now. The boundaries are blurring. There are lots of things to be done before it can come together. And who knows? It might be more useful than the ATM in the long run. So,
well, we hope so. Klaus, you've heard two stalwarts from the private sector. Let me ask you to put back on your regulator's hat as both the head of a central bank and of the Financial Stability Board. You've grappled with these issues: central bank digital currencies, stable coins, all part of a payment system which is efficient. So do we need both? Do we need neither? Does your answer depend on something? What do you think about all this?
Well, thank you very much, Raghu. And again, it's great to be back in the community that I have been part of for a long time. I would actually start from the other end. Why would we abstain from one of these alternatives? So if I think about the digitalization of finance, I actually think in sort of 3 C's: complementarity, convertibility, and control. Complementarity because, of course, these digital instruments are all new, but what they try to achieve, the functions of money have, of course, in history always been tried to achieve by payment instruments. And I think the history has taught us that stable monetary and payment systems were always systems that found a certain balance between public money, preserving public trust in the system, and private money, making sure that sufficient innovation took place, convenience, efficiency, etc. The things that on the public side probably we are a little bit less specialized in, I would say. So historically, that has always been a stable combination. Where there was a private money only system, it never lasted long, and it usually ended in tears. Now, if you then take sort of that approach, then in the analog world, we have cash, we have deposits, we have money market funds, and we have all kinds of risky investments. In the digital world, you would have central bank digital currency, you would have tokenized deposits, you would have CBDCs, and you would have speculative investments like Bitcoin and the others. And I would argue that actually the strength of the system would lie in the complementarity between those, because they fulfill different roles, but they also take on different responsibilities. But what is crucial for the system to function is obviously convertibility. Because I do think that a lot of the stability of, let's say, private money exists by the virtue of the possibility to convert in public money. Stablecoins are runnable. They're runnable liabilities. We know it. It's like a money market fund. So what is a run? Well, a run is typically that as a sort of investor, you want to convert your claim on a private entity into a claim on a sovereign entity. In the analog world, you want to convert, for instance, your bank deposit into cash. You go to the ATM and try to take your money out of the bank. In the digital world, that would mean that you would convert, for instance, your stablecoin into a central bank digital currency. For me, it's an interesting question. What would happen in societies where you would have stablecoins, but you wouldn't go for a central bank digital currency? One of the main reasons why I believe in Europe that we should go for a central bank digital currency is, for instance, also that cash is, well, it may be an exaggeration to say on the way out, but still in many, many of our societies, I think the usage of cash is greatly reduced. I mean, if I try to convince my children of cash, they would really not know what to do. If I gave them a banknote, what the function would be, they'd never see cash in their life, and they might never see cash in their life anymore. So if we were not to substitute cash by, let's say, a central bank digital currency, what we would in fact be doing is we would allow our money and payment system to gradually morph into a private money system only. And I think historically these systems have not been very stable. So that's why I think convertibility is also key. Finally, I already alluded to the fact that stablecoins are runnable liabilities. And history, unfortunately, also teaches that constructs that are runnable, at some point in time, they will be run. So that means that there are certain risks that will have to be managed. I believe that for that we need regulation. We need regulation where we should also take some lessons, for instance, from money market fund regulation. So there will have to be liquidity buffers in place. There will have to be good transparency about the valuation of the underlying assets. And then we also have to think about the possible cross-border aspects of it. Because if CBDCs are used for sort of active dollarization of, let's say, emerging markets and developing economies, of course there is a risk in these economies that this would destabilize local banking sectors. Now you may say, well, dollarization was already with us also in the analog world. Yeah, that's true. But I think in the digital world, the transaction costs of doing that are much, much lower. So things can move a lot more faster. So I do see room for both CBDC, for tokenized deposits in Europe, by the way, where you have more bank-dominated financial intermediation. I think there is probably more scope for tokenized deposits. In the US, you have a sort of a sizable T-bills market that could sort of form the assets covering some of these CBDC. We don't have such a T-bill market in the EU, so maybe in our part of the world, tokenized deposit is a little bit more convenient. But in any case, I think these private initiatives can be complementary. They can take care of the innovation, the convenience, the efficiency, etc. But they should definitely be properly regulated because these are not risk-free constructs.
Great, thank you. I think we had a fairly detailed elucidation of each one's position at this point. Now we can get into a real conversation. Heath, just want to throw the ball back to you. We had both Venkat and Klaus talk a little bit about the risks, customer protection, runnable. How do you see that? What do you think about that?
I very much agree, and there's the interesting thing. Venkat and I aren't trying to eat each other's lunch. We actually want to have lunch. There's a lot of work that we can do together. In many ways, the four things that you mentioned that Barclays does, we might do two of them. We are not interested in credit provisioning, maturity transformation. We're interested in building that infrastructure layer and then providing that payment tool. In my view, the biggest threat to stablecoins are not CBDCs, and they're not tokenized deposits. They're bad stablecoins for all the points that you just mentioned. For this to work and work well, right? Redeemability. And in our case, right now, there is no CBDC. There probably isn't going to be a CBDC in the United States. There are certain people in this room, though, that have the ability to change that policy and go forward, and we'll see what happens there. But at the very least, it has to be redeemable one for one for $1. And that means that for every USDC, for example, that's issued, or any other payment stablecoin, it should be backed one for one with dollar, effectively cash and cash equivalents. There should be redeemability. There should be transparency. The financial statement should be audited. All of those features are critical to making sure there's the complementary, there's the run risk is significantly reduced, if not eliminated. All of those things are absolutely critical. But if you look out to the world of stablecoins, that's not there. Europe moved first with MiCA. The United States just moved with Genius. But there are still, the majority of stablecoin circulation are not subject to any rules. So it is very critically important, in my view, that we stand behind really important sound regulation.
Venkat, he just said you're on the same page. You're going to have lunch together.
Yes.
Do you, yours is a 300-plus-year-old institution. I missed the exact age.
Yes, 335.
There's a lot of tradition, a lot of legacy that's good in many ways. That also makes it harder to move fast.
Yeah.
Is that a concern? And are there vulnerabilities? Are there advantages?
So it's a concern from the willingness to understand, not the ability to understand and adopt and implement technology quickly. And it's a concern in two ways. One is there's a higher displacement cost for whatever you adopt. You have to throw something else out or replace something else. And then the second thing is the workforce is not as native to the new technologies as probably the engineers at Circle are. Having said that, I think then taking that technology and developing a product that we think is appropriate for our customers, we have not just an advantage in, but I hope we take the appropriate time to do that, because we're trying to replicate safeguards, not put the product out and then finding the safeguards later. Right? Now, I'm not saying you're doing that, but what I'm saying is in the mental construct that brings a product, maybe slower than you should be in implementing the technology, but appropriately deliberate in deciding what product features you should have, what safeguards you should have before you put it in.
So you're saying trust substitutes for agility a little bit?
Trust is given a lot of importance compared to agility, because you can't be agile because of your existing legacy of systems. You also care a lot about trust, because a trust problem in one small part contaminates the entirety.
I'll come back to you, Heath, about trust. How do you build trust in your system without the benefit of 330 plus years?
Yeah. And Raghu, just for that point, I mean, we have deposits. So if we had stable coins, we'd have to be very clear whether they're deposits in the traditional insurable sense or not.
Right.
So just that one simple thing is really important. And then, of course, what role it plays in the monetary system.
So, Klaus, I want to get back to your point about convertibility to I think you implied that having a central bank digital currency was necessary to make this work well. Otherwise, you worried a little bit about an entirely private digital system. How would you advise the US?
Well, I just wonder what would happen. I mean, let's first sort of illustrate that this run risk is not just hypothetical. I mean, in 2023, the top 25 stablecoins depegged no less than 600 times. Okay? 600 times. That was 2023. Now, you can say, is that a sign of stability or is it a sign of instability? You can say it's a sign of instability, it's so many depegging moments. You can also say, well, not much actually happened, and there was acceptance of temporary depegging, and etc. So you can have a debate on whether it's stability or whether it's instability. But nonetheless, I think the depegging and the questions around sort of whether the full coverage is still there, it's very much akin the uncertainties that you sometimes also see in the money market fund world, and that's, I think, where we should learn the lessons from. Now, if such a run were to occur, then of course the question will be in the US, where will they run to? Will they go all the way out of the digital system back into cash? Might they go to a central bank digital currency of another jurisdiction? That would be quite funny to observe, I think, privately. But okay. And that's why I come back to where I basically started. Why would you abstain from one of these options? Why would you close down? We're all doing a digital update of these instruments. Why would you upfront say, oh no, we're not going to do this one, we're only going to do this and this and that one? I think you sort of stopgap some of the possibilities that you don't know beforehand whether you can use it or not. I mean, you can have a debate on whether the stability of private money is premised on the convertibility possibility. I think historically there's a lot of evidence supporting that claim. Will that also be true in the digital world? I don't know. But why would I abstain myself from the possibility of having that option?
Heath, to the point about trust, can you substitute for trust with technological solutions? Are there ways you're building the trust that Venkat talked about that his bank enjoys because of the many years it's been in the business?
So I would say yes and no, in the sense that, yes, blockchain actually takes away some of the trust factor, right? You don't necessarily have to rely on a big systemically important institution in the middle of the blockchain because of all of the advances in cryptography that's able to validate transactions. So in that sense, there are technological sort of innovations that eliminate the need for traditional means of trust. But at Circle, I can tell you, trust is everything.
There are some concerns even there, right?
There are some concerns, of course. But at the end of the day, there are still many concerns about our banking system. And so the interesting question is, people don't want CBDCs because of trust. Different kind of trust, not financial stability trust, or at least there's a large portion of folks in the Western world, okay, and you see this in this country, you see this in other countries. It's not a financial stability issue. It's a privacy issue. It's a sort of government's going to cut off my. So there is, I would say, a major trust factor in all of these kinds of digital assets. You think about tokenized deposits. Banking system, at least in the United States, comprises thousands of different institutions. Many of them have very older technology. For example, if you were to tokenize all of those deposits, I would think the run risk would be magnified substantially, and I'm not sure our current banking system, as good as it is in terms of regulation, is quite ready for that. I can tell you at Circle, trust is absolutely critical. So one of the things that we did early on was say, what does good look like? And it was all those features that I mentioned earlier, and to some extent we applied those things to ourselves, even though some of our competitors overseas were not doing that, to help build up that trust. So I don't think you can eliminate trust. I think trust is absolutely central to the financial system, even as we move to a digital age.
So let me ask you, is there a product that you can envisage with stablecoins underlying it or being part of that product, which makes the system safer than it is now currently? Is there something that would add to status?
One of the interesting things that we're thinking about now that I didn't mention in sort of the litany of these are all the use cases is in the markets that I used to regulate, the largest markets in the world by notional value, our derivatives markets. There, obviously, we need substantial initial margin and variation margin flows to make that work. But the cost of moving money, the time in moving money, ends up clogging the system with arguably more margin than we necessarily need. So if there is a way to make margin more efficient, it could end up making the system safer and more efficient, particularly with flows that are, again, large flows from major financial institutions. And again, there's the systemically important clearinghouses right in the center of it all. So I do think technology, the speed and the reliability of it can improve things majorly. By the way, I think my view of what a DPEG is in the stablecoin world is when the issuer themselves, for example, doesn't honor something one-to-one. That has happened, particularly with algorithmic stablecoins, but there are secondary market dislocations. But again, I think it's really important that technology ultimately, the more that it builds out, the more you'll start to see the bad actors move away, particularly as regulation moves in.
So you're saying backing flows with underlying collateral, which is quickly movable, is a way of making this.
Is a way of reducing friction and therefore arguably risk.
So Venkat, I have a two-pronged question for you. One, tokenized digital deposits. Do you have much success with that? Is that catching on? Is that relatively small at this point? So that's one. And they sort of compete in some ways with the stablecoin.
Yeah.
What would you want for the playing field? You talked about level playing field. What would you want for the playing field to be level?
So the answer is tokenized digital deposit, certainly for us, is at a very nascent stage. What I would want is to know a few things. One is, if it is a form of cash, then it can be moved between banks. And so that interoperability and the common network is really important. And in the UK, we're trying to do both. The second thing I'd want to know is that whether it sits with me or whether it sits with any other institution, if it is cash, and it should be what a customer thinks of as cash, which is something that is redeemable on demand and that is protected with whatever consumer protections they have, including deposit guarantees. The third thing is if it plays a role in a monetary system, ultimately in helping, implement monetary policy, it should play that role or not. It just has to be clear to everybody what that is. So there's a huge educational part to it. I completely agree with Heath, which is that the more technologically sophisticated you get, then you're asking the underwriting institution, the institution that creates it, to underwrite the technological workings of it, which is not just that our records are right, but if it's going to have certain properties, that it will have those properties and it will behave in the way you say it will. And you're right, not every place can do it. The larger institutions can to begin with. So, but that trust is really important because you're adding a dimension, which in this room may be well understood, but when you go to millions of customers, may be less well understood. And the last piece of trust, if I may, is even if they didn't understand it, and it turns out they own it, and it turns out that they're puzzled or think it behaved in a different way, they'd want you to assure them that it was appropriate for them to have had it in the first place. Right?
That's puzzling. Tell me a little bit more about that.
Well, it is whether whether something is an appropriate investment for somebody.
Okay.
Right? Cash is an investment also.
Yeah.
So was it appropriate for them, based on their financial circumstances, to hold this and their level of financial sophistication to hold this? That's the basic point.
So, Klaas, both Venkat and Heath have talked about the trust factor, right?
Yeah.
Now, Venkat wants the playing field to be level. I think both of them want the playing field to be leveled. The question is, what is level? Is the faith in the deposit and the one-to-one convertibility in part owing to the full faith and credit of the government being behind the large banks? Is it deposit insurance? Is it too big to fail? Or is it narrow banking, which is one version of stablecoin, not the only version, which is, how do you keep the playing field level? Should you add guarantees to the stablecoins from the government, conditional on supervision or conditional on checking the assets are largely high quality? Or would it mean something else?
Well, that would be quite some extension of the safety net, no? I can understand if you move from deposits to tokenized deposits, that they would be part of deposit insurance schemes, as they are also in the analog world. But there is an issue here. If you were to also extend deposit insurance into stablecoin, that's possibly quite some extension, I think, of the safety net with which you have to think about whether you really want to do that in terms also of creating moral hazard and the like. So I was so far always sort of working on the assumption that this difference would continue to be there, as in the analog world there is difference between bank deposits and money market funds at this moment in time as well. So that would not be a foregone conclusion for me.
Okay.
Can I just respond, because I felt I had to respond a little bit. I know these stories, these sort of conspiracy theory stories, Big Brother and CBDC being used, that you can't eat meat anymore and only vegetables, and that sort of the central bank is going to decide your consumption pattern, etc. I would just say I'm coming from the part of the world that probably has the most stringent privacy regulations probably relative to other parts of the world. Why would you assume that these privacy regulations would not apply to an instrument that is issued by a public authority? Is this not a little bit putting a libertarian veil over what is in essence a commercial argument? I mean, of course, if you're worried about programmability, if you're worried about Big Brother type of things, there are ways to issue that to settle that in legislation. Make sure that it doesn't become programmable. Make sure that the sort of issuing central bank will have to delete the data as quickly as possible, etc. So I know that these theories go around, but I must say that I think that this is a manageable risk.
Manageable in the right country.
Oh, yeah. Okay.
So just putting you back on the spot for a second, is Europe worried about dollar dominance via stablecoins, via dollar stablecoins?
No, I would think that the countries that should be worried about possible dollar dominations by stablecoins are more the ones that have difficulty traditionally themselves to deliver price and financial stability. So coming from a region where I do think we have an independent central bank whose commitment to price and financial stability is not in question, where we have a relatively stable currency with price stability, etc., I'm not so worried about disintermediation by dollar-dominated stablecoins. But this is, of course, not necessarily the case for countries that have had a tradition of high inflation, of having difficulty keeping price stability in check. And as I said in my opening remarks, this risk has always been there, but in a sort of cash format, dollarization, I think, takes more transaction costs than in a digital format. So there I see an increased risk.
So Heath, on this issue, to the countries which don't have that credible currency, that effective a financial system, there is a great worry about dollarization via stable coins, and they will lose all the benefits of having their own currency. Is that a good thing, bad thing?
Yeah, we take a nuanced view at Circle on that, in the sense that I think there is something to be said about citizens of the world being able to choose, right, and not being necessarily forced to choose one currency or another. At the same time, I think our approach has always been, let's go in through the front door, let's have a dialogue with the central bank. In many cases, the central bank is working on a CBDC, for example, even though the United States isn't. And for that CBDC to work, particularly cross-border, it needs to be interoperable with a dollar stablecoin, and most countries are going to choose a dollar stablecoin that's compliant with MiCA or compliant with Genius, for example. And we're very careful to also make sure that we're abiding by exchange controls, for example. So I think it's up to the stablecoin issuer. It is something that we're certainly sensitive to, but our view is that ultimately the current monetary system will largely be replicated on chain. Maybe these three types of things, tokenized deposits, some central bank digital currencies, but in all fiat currencies. And so we're actually looking to partner with folks who are going to be issuing fiat currencies and local currencies to make them part of our network, for example.
Thanks. Venkat, on the issue that no panel is complete without a discussion of AI, how does AI, how are you looking at AI within your bank? Are you implementing it? How does that go? And just latest, how do you see Mythos or Mythos?
Yeah. Thank you. It is obviously the question that is everywhere, as you say. It's a very, very important transformative technology with great potential. All of us who use it personally see it. When you come to large institutions, we find that there are three aspects of it that make it hard. The value is tremendous, but to realize the value, it's hard. One is what I'd call adoption. Part of it is making it available, which is, does everybody who, if you're on Microsoft, have Copilot? Second is, are they using it, and how are they using it, individually or in small groups? That's the adoption. Second is, if you're going to do it in a serious way, your infrastructure needs to be up to the mark, including data storage, data availability, and your access to compute platforms, especially in the cloud. So look, all big institutions have different systems at different stages of technological advancement, so you've got to upgrade the whole thing. And the third one, which depends on the first two, and it's really the hardest, is can you identify true high-value use cases where an end-to-end process, a big end-to-end process, is completely replaced. You throw away the old, you apply it with AI, you use the new, and it's at least as good, right? Hopefully better. That is the thing that's really hard to get done. We have a few in flight, but the more you try to do it, that is what we are finding to be the hardest case, because it is really requiring a huge degree of change, and sometimes you'll run into obstacles that you have to overcome, either human obstacles or process obstacles. On Mythos itself, look, it's a serious threat, it's a serious issue. We have to understand its capabilities, and we have to understand how to safeguard against it. But here's the thing. This is probably going to be the first of many, right? There will be a Mythos 2 and a Mythos 3, and they'll come up with probably distressing frequency. And so then the question really is, you're again in a race, but it's a race that's taking place much faster. And how can older institutions and larger institutions move quickly enough, because you're only as weak as your weakest link in your system. As strong as your weakest link.
One quick add-on to you, Venkat, because I think you mentioned infrastructure. And earlier on, Raghu, you mentioned about the blockchain itself, but I think it's a really important point. For any of these types of digital currencies to work, the underlying infrastructure has to work. It has to be trusted more than anything else. Many of you have come in from overseas, and many of you I know are going back and forth between New York and DC. The train engines, the Excella engines, are meant to go 165 miles per hour, but yet they go less than half that speed. Why? Because of the tracks. The tracks are old, the tracks are antiquated. And so while probably Circle is the world's largest regulated stablecoin issuer, we've actually been investing over the last year in the tracks, in trying to build that layer 1 blockchain that is enterprise grade, that central banks could potentially trust, that large financial institutions that have been around for 330 years of trust. And that, a lot of investment is needed in that. And I feel it would be remiss if I didn't mention that in this panel, because in some ways it underlies everything.
Absolutely.
In that context, I mean, I've so far been speaking predominantly about retail CBDC. I would argue that wholesale CBDC is part of these tracks that allows you to settle your transactions in central bank money. So that is, I think, another example where you have obvious complementarity between what you want to achieve and what we can actually deliver.
And it doesn't raise that trust, the same sorts of trust issues that a retail CBDC would, for example.
Or suitability. Right.
Mm-hmm. Well, let me, before going to the audience, give Klaas a chance to talk about that wonderful report that the managing director highlighted on non-bank financial institutions. Klaas, a few words on what you did there?
Yeah, I think, NBFI has been with us for quite some time, and to understand how sort of the issue arose, I think you have to go back to even the global financial crisis of 2008-2009, which was clearly a banking crisis that generated a lot of systemic risk. It gave rise to a financial reform agenda that I think has been extremely effective, and effective in the sense that it changed the banks from shock amplifiers during the crisis of 2008-2009 into shock absorbers, if you look at the financial market shocks that we've seen over the last 5 years and so. But as a side effect of sort of strengthening the resilience of the banks, some of the financial activities, and unfortunately also the associated risks, have moved out of the banking system into NBFI. Think about market making as an activity, but also think about private credit, which is very topical, I think, at this moment. So since roughly 2020, when we saw the dash for cash, and later on we got Archegos, we got the commodity traders, the UK LDI episode, etc., within the FSB and the regulatory community, IOSCO, we've been quite concerned about NBFI, and we've made efforts to bring the resilience in the NBFI space more up to speed and at the same level, although resilience in NBFI is a completely different concept than resilience in banking, but at least try to sort of level the playing field between the two again, in terms of strengthening liquidity management practices within the major players. Think about open-ended funds and money market funds, but also working on a couple of cross-cutting issues, I would say. Lack of liquidity preparedness for margins and forms of hidden leverage that popped up in all of these episodes that I just mentioned. However, despite all these efforts, we must also conclude that implementation has been quite uneven. And uneven is quite a euphemistic word, I can assure you, if you're a public official. And so we have been wondering ourselves, we've been asking ourselves, why is it so difficult to sort of get to more, let's say, stringent and more, more comfort in the safety and soundness also of the NBFI space? Well, probably because it is a more heterogeneous space, where also regulatory powers are more dispersed, where also some of the regulatory agencies are not as much focused on financial stability and don't have financial stability as much ingrained as, let's say, banking supervisors. But nonetheless, it continues to be an area that provides a lot of concern, and where the progress that we see in implementing the recommendations is simply not enough, in our view, to manage the risk. There is nothing in the report, let me state it honestly, that has not been identified earlier on. But the concern is, why can it not be done? And if it cannot be done, then I do believe that this continues to be a major vulnerability, and that is what we have tried to describe in the report.
Absolutely. It's available outside. Please take a look if you get a chance. Let me now open it up to the audience. Please, if you have a question, stand up, indicate your name and institution before speaking. We have people with mics in the aisles. Up there.
Good evening. Thank you very much. Brunello Rosa and Rubini Associate. Hi. Couple of questions. One technical. So we have spoken about jurisdictions in which the CBDC is not present. What about the possibility of giving stable coins access to the central bank balance sheet through, for example, a skinny master account, as it happened in the US, and creating a sort of synthetic CBDC? Could that be a solution in jurisdictions where there's no CBDC? That's the technical question. Then they have a more geopolitical question, if I may, because there's a huge geopolitical component into digital currencies. I mean, the Iran situation shows how important that is when the toll for the Strait of Hormuz was paid either in Bitcoin or in ECNY, so the digital yuan. So my question, perhaps also to the G30 organizers, is why is not the PBOC part of the panel, which I think is a very important component into the developing digital finance world? Thank you.
Back there, let's take a couple of questions and then give it back to the panel.
I'm Anant Nageshwaran, Chief Economic Advisor, Government of India. It might sound a bit simplistic and obvious, but still, can we establish the economic case for digital finance or tokenized deposits? If speed and cost are the only two factors, cost is an income for somebody else. They take ownership and responsibility. In digital finance and tokenized deposits, who takes responsibility and ownership? Second quick question, what has blockchain delivered so far? And three, who prefers anonymity? Thank you.
Okay. I think we have 5 questions now, so maybe, Heath, you want to take the first stab at the questions?
Sure. All right. There's a lot there. I think there was a question, what has blockchain achieved so far? Well, I think it has shown that you can move value at very little cost, 24/7, around the world. So I think it is a major leap forward in the movement of value. I think the cost part of your question, I think it was sort of like if you remove the cost, then someone's not benefiting from that. Was that, I sort of got that sense? Well, I mean, I think the view is it's better for movement of money to be as frictionless as possible, all things being equal, provided there's applicable law, there's applicable regulation, and that taking out the middle people who are rent seekers is good for everyone who's moving money. Maybe I'll stop there and let others tackle some questions.
Yeah, I want to come in on the safety net. I mean, if you run a stable coin, it's hugely profitable, right? I mean, you get a lot of returns on assets. You don't pay any remuneration, as of yet, on the liabilities. I would love to have a public guarantee by access to the public safety net, but is that not another form of privatizing gains and socializing losses big time? So, I mean, if we still believe that risk and return should be sort of two sides of the same coin, then I do think that this is an undesirable extension of the safety net into an area where I think there is a lot of private return already. Finally, I do want to come in on the anonymity issue, because obviously stablecoins are far more efficient than traditional forms of cross-border payments. And I think it is one of the reasons why stablecoins also came up so quickly. Because we probably on the official side have failed to modernize traditional forms of cross-border payments sufficiently. And it is still very slow, very costly. Also, yeah, there is a lack of inclusion, etc., etc. But there remains, of course, the question: what is the extent of, let's say, that this cost differential? To what extent can it be explained by AML CFT controls, which are quite cumbersome and costly, and to what extent is sort of the fact that that stablecoins are cheaper and more effective due to the fact that AML CFT controls are not at the same level of, let's say, traditional payments, because that, in my view, would be an undesirable and an unfair competitive advantage. I would think that in terms of stablecoins, we need to also bring AML CFT supervision to the same level than traditional forms of payment. Now, given that it is digital, probably there is scope to do that much more effective and much more efficient. I think a lot of the AML CFT that we do is rather archaic at this moment, definitely when it comes to the gatekeeper function. And there are, I think, digital ways to do that more efficiently, effectively, but it needs to be done. And it should not be overlooked. It should be an integral part of the operation of stablecoins as well.
Yeah. So I agree with the point Klaus just made. I was going to make it myself, which is that if you believe that credentials are incorruptible and verifiable, then this is a real benefit. If you can have AML KYC done instantly, verified instantly, and then you can move money faster. And I think, Anant, to your other question, to the degree that you can speed payment, liquidity discovery can happen faster, right? So today you wait till the end of the day for somebody to move collateral to you, let's say. And you can sometimes, if it's a risky situation, you don't know if they have the money at the end of the day. To the degree that you can move that faster, and I think you see it in India with what a UPI has done, which is the availability of instant payments, does actually reduce frictional cost. So I think that's a valuable thing. Now, it comes back to what I said. Therefore, why do you need a digital currency? Right? You need a digital currency because of some of the other aspects of it, which can allow you to verify not just holdings, but certain other properties of the currency and make it move faster.
Yeah. I had just one quick add-on. On the AML point, it's important to know that stablecoin issuers, at least like Circle, apply the same exact law. So our customers, we KYC them, we go through the whole rigmarole. The issue is once it leaves us and goes out there on the blockchain from peer to peer, then there needs to there's not the digital identity and the KYC. Now that's true in the banking system as well. Once it leaves the bank and it's being handed from peer to peer, but it is something that I think we all should work on. On the accounts and the central bank access, very important point here. I do not think there should be a safety net extended to stablecoin issuers. I do not think Federal Reserve liquidity, they should be necessarily borrowing. I think there needs to be, and the Genius Act went far in this direction, is making sure that reserves are segregated, they're protected, and if there is an insolvency of an issuer, that issuer fails and everyone's made whole because the reserves are there. That said, what would be useful is a place to put our money. And I experienced this during the COVID crisis when our large derivatives exchanges had so much cash and the banks wouldn't take the money. If there is an ability to place cash at the Fed when no one else will take it, or the banking system is undergoing some fragility, that could be useful.
That's a nice distinction. I just wanted to add my little bit as a former central banker on AML CFT. We also have to keep modernizing it.
Yeah.
It gets stuck in the box checking exercise of old. It's not useful. We need to use some of these technologies to say how do we do a better AML CFT. Other questions? Axel.
Thank you. Axel Weber, formerly Bundesbank. So on the issue of skinny accounts, I think it's a very bad idea. But you wouldn't be surprised. We had something like that in the Euro system at the Bundesbank with a very clear destination for money handlers. So if you are in the business of money handling, there is no reason why not. And believe it or not, when the financial crisis hit, I had calls from every corporate in Germany. They wanted to open a central bank account and move away from the banks. I had a very easy answer. Are you handling money? Or are you a firm? So I think there are ways of doing it if it's part of the cash, part of the cycle. Not just because I'm sitting next to Andrew. I'm much more in favor of the UK approach, where I don't think, given that central bank money is like a decade away, that, or maybe 5 years, that tokenizing deposit is in its infancy, that you will have a chance to keep the third form of digital money, that is tokenized money and stablecoins, out of the market, because it's there and it's a reality. It will outrun all other alternatives, and it's very hard to restrict in the market access. So wouldn't it be better to embrace a hybrid system just like we do have now in the analog world and really drive that forward? And maybe because, stablecoins are out of the hole earlier, regulate that to a degree that you prevent accidents, because I'm with Heath. The first reputation hit for that market is the worst performer in that market when they hit the wall. So I think because it's out and there, you have to be pretty pragmatic about the sequence at which you phase in these three forms of money in the future. And if the accident happens on the part you like least, you probably get a lot of blame. Maybe some reaction to that.
Let's see if there are any last questions out here. Okay, let's go back. Oh, there's a question there.
Thank you. Jolanta Waisaka, Mount Pacific Group. Question about recent drift protocol, and last year the Paxos minting, if I recall correctly, $230 trillion worth of their stablecoin. And of course, then they quickly discovered the mistake, but yet alone was minted. So given the speed at which these transactions can occur, can you elaborate how you plan to safeguard against those? Thank you.
Any other questions? Okay, let's go to the panel again for a last round of responses.
Sure. I think, well, first of all, I think Axel made my points in a far more eloquent way than I did, so nothing to add there. As to the second set of questions, the drift protocol was a situation where North Korea hacked a DeFi protocol. And our position on that is that we work with law enforcement. We don't seize people's property unless there is an order from law enforcement. Or an intelligence agency, provides us with an official request, because it's people's property. And so that's how, in those situations, we respond. We have a rule of law approach. But and then that is what the Genius Act says. But it's important, I think, another area of policy development for stablecoin holders, but also it could apply to tokenized deposits as well, is providing safeguards and further study on those areas. The minting of a competitor that you mentioned, where they minted trillions of dollars, clear operational risk. And so we're very mindful. That's why we're going to be subject to OCC supervision, just like banks have operational risk. Technology firms have operational risk as well, and it's something that we think about each and every day and devote resources to.
Fantastic. Venkat, your last words.
Yeah, look, I agree with what Axel said. And I think it sort of brings together what we're talking about, right? Which is that we can't stop the technology is here. We don't know what form it'll take. The first asset that it takes hold, probably stablecoin, because it's the most advanced. But then you have to ask, what is it? How is it being sold? What do people think they own when they own it? What are the protections around it? And I think the sooner we get to that for one digital asset, then the easier it is to go to the next one and the next one and the next one.
Yeah, couldn't agree more. I think complementarity is where I started my my discussion with. And yes, stablecoins are probably ahead of the pack, but that's normal, right? That the private sector innovates and then the public sector has to think about the risks and will always be a little bit behind that curve. I think that is inevitable. But we need to regulate, and at the same time, I think the development of CBDCs, both on the retail and the wholesale side, tokenized deposits, I continue to think that up front there is some conceptual superiority in the product relative to a stablecoin. But then again, it's not up for me to decide. I mean, if there is more demand for stablecoins than tokenized deposit, let's see how we can sort of accommodate that demand, while at the same time being very cognizant of the risks, taking also into account the cross-border aspect of it, because I do think that this is an issue for international cooperation. This is not an issue for jurisdictions to go at it alone. And I mean, Andrew is in the room. He has taken over the baton from me in this regard, and I know he's working hard on this, and I think we should all support his efforts within the FSB to make sure that we also have a globally coordinated approach, because if any business is cross-border, it's this business.
Well, with those wise remarks, it's all that remains is to thank our panelists for those wonderful remarks. So thank you, Heath, thank you, Venkat, thank you, Klaus, and please join us outside for a reception. Thank you very much, everyone.